We're live, dude.
Good morning and good afternoon to those of you who are viewing from Europe. I'd like to welcome you all to this morning's event on avoiding another Eurozone debt crisis. And I'd particularly like to welcome our truly distinguished panel of experts who hardly need any introduction. In the order in which they're going to speak, they're Charles DeLaura, who is chairman of the board at Partners Group, United States of America. He formerly served in very senior policy positions at the US Treasury, as executive director at the International Monetary Fund, and he was also president of the International Institute of Finance. Charles is also the author of the recently released book, Euroshock, which is an excellent book on the 2010 Greek sovereign debt crisis. Charles will be followed by Jacques de Larosière, who was formerly governor of the Banque de France, and he was managing director of the International Monetary Fund. It was my privilege to have worked in the 1980s under Mr. de Larosière's remarkable and inspiring leadership. He's also published a book entitled Putting an End to Financial Illusion, which provides a timely critique of monetary and fiscal policies in recent years. Mr. de Larosière will be followed by Professor Pietro Carlo Paduan, who is currently chairman of UniCredit. He was formerly Italy's Minister of Economy and Finance and an economics professor with an international reputation. Last speaker will be Athanasios Orphanides, who is an MIT professor of economics. He was formerly head of the Cyprus Central Bank, and he was a member of the Governing Council of the European Central Bank. By way of introduction, I'd like to congratulate Charles on his highly informative and enthralling book, recounting the negotiations that succeeded in allowing Greece to restructure its government's debt. That was the largest government debt rescheduling on record. I would suggest that this should be required reading for anyone who might be involved in trying to avoid or deal with the world's next major debt crisis. It also served as the basis for this morning's discussion as to how the Eurozone might avoid another sovereign debt crisis. By way of introduction, I'd also like to add that Eurozone's economic performance since the 2010 Eurozone debt crisis has left a lot to be desired. Let me just note a few points on that matter. Over the past 15 years, the Eurozone's economic growth has fallen considerably short of that of the United States. More recently, the Eurozone has experienced its worst inflation since the Euro's 1999 launch, partly as a result of a Russian-induced energy shock and COVID-related global supply chain disruptions. What is of particular concern is that the public finances of a number of key Eurozone member countries, including France, Italy, and Spain, appear to be on unsustainable paths, as underlined by public debt levels and budget deficits well in excess of the European Stability and Growth Pact limits. It's also to be noted that the European Central Bank, has resorted to a highly unorthodox monetary policy that has included negative interest rates for a prolonged period of time and purchase of massive amounts of Eurozone government debt in general and of the Italian government in particular. We might also note that the Eurozone has made relatively little progress towards fiscal and monetary union, and now it appears to be falling behind the United States and China in the artificial intelligence race. All of this raises a number of pertinent questions for the Eurozone's economic outlook. What measures might be taken to improve France, Italy, and Spain's public finances within those countries' Euro straitjackets without triggering a recession? In the event that we were to have another round of the Eurozone sovereign debt crisis, what would be the appropriate ECB policy response? What lessons should the IMF, the European Central Bank, and the European Commission learn from Greece's earlier experience with debt refinancing? 25 years after the Euro's launch, the Eurozone monetary union is far from complete. What are the prospects of the Eurozone moving towards a fiscal union and a banking union? The German economy now has been hit particularly hard by the Russian-induced energy shock and by the marked slowing in Chinese economic growth. What does Germany need to do to restore its economic growth momentum? And finally, like their American counterparts, European banks are having to deal with high interest rates and troubled commercial real estate lending. What measures might need to be taken to strengthen the Eurozone's banking system? Those are a bunch of questions. I don't expect each of the panelists to answer all of them, but I thought that they might provoke some kind of discussion. So without further ado, I'll ask Charles to open the discussion with some reflections on the lessons to be learned from the Greek debt crisis. Charles, the floor is yours.
Thank you very much, Desmond, and thank you for your kind remarks about my book, Euroshock. It's an honor to be with you today and with these other distinguished leaders in global finance. Much of what I learned firsthand about dealing with global financial crises, I learned at the feet of Jacques de la Rosière, and I think we all have seen the remarkable leadership over the years as well of Professors Padoan and Orphanides in the fires of coping with challenging circumstances in Europe and in their own countries. Looking back, Desmond, the period of 2010 to 2012 nearly ripped the Eurozone apart. I think it's very important to recall how difficult the circumstances were. The crisis arose soon after the world economy was recovering from the global financial crisis. And the Euro crisis, one might argue, began in Ireland, but soon migrated to Greece, to Italy, to Spain, and Portugal. For a period of time, it was very unclear whether or not the Eurozone would hold together or whether or not Greece would be forced out of the Eurozone, fracturing this common currency and perhaps leading to a further destruction of the unity and solidarity of the Eurozone. What enabled Europe and Greece to avoid this outcome? I was asked as the head of the Institute of International Finance to lead a group of creditors in what was a rather extraordinary and for me highly unusual process of restructuring Greek debt. I've been involved, as you mentioned, in sovereign debt issues since the early 1980s, but I'd never been involved in one where the country was embedded in a common currency, where it had no individual exchange rate or control over its monetary policy, and where it virtually had no voice, actually, during the course of the negotiations. The negotiations were further complicated by the fact that the Euro side, or the debtor side of these negotiations, was led by the Deputy Finance Minister of Italy, which I thought was rather bizarre. He was the deputy head of the Eurozone finance ministers, but he was also coping with his own crisis in Italy at the time. And this complicated circumstances significantly. Furthermore, I would add that the private creditors themselves initiated this process of restructuring the debt, which is exceptionally rare. The eventual outcome, of course, was achieved in the spring of 2012, when well over half of Greece's sovereign debt was either completely eliminated or restructured on concessional terms. And one morning in March of 2012, 107 billion euro was extinguished, and another 100 billion or so of euro claims on Greece was rolled out for 30 years at highly concessional rates. This, of course, was not the whole story. Greece implemented severe structural adjustment and fiscal deficit measures, and also was supported by considerable financing from the Eurozone and from the IMF. Mistakes were made along the way, and I think it is terribly important that we reflect a bit upon the lessons learned and the lessons still to be learned, because it's far from clear to me that Europe is significantly better prepared today to cope with a sovereign crisis than it was at that time. If you look at issues such as banking union, the progress toward unifying the framework for coping with the banking crisis is only partly accomplished. If you look at the scale of the European Financial Stability Facility today, it still is grossly inadequate to cope for a potential sovereign debt crisis in a country as large as, if I may say hypothetically, as large as Italy or France. If you look at the IMF, the role it would play in another sovereign debt crisis remains very vaguely defined. During this past Greek crisis, the IMF was heavily influenced, perhaps politically understandably, but not necessarily very productively, by German finance officials, and insisted on a series of fiscal adjustments, which at one point became counterproductive. What is the role of the ECB in another crisis? And this looms as a very large question, since the ECB has absorbed billions of euro, hundreds of millions of euro, and billions of euro of sovereign debt from other countries over the years, including especially from Italy. We live in an era, more broadly, where sovereign borrowing is not very effectively managed or supervised either by the borrowers or by the capital markets. If you look back to what allowed Greece to get into such difficulty, it was a combination of fiscal profligacy on the part of successive Greek governments and very poor risk management on the part of the creditors themselves and the investment banks which were underwriting the debt. Lessons need to be learned from this, and frankly, the effectiveness of government borrowing offices and sovereign borrowers around the world needs to be greatly enhanced. Understanding better the risk and communicating them to political officials. At the same time, the standards of risk management in investment companies, in pension funds that invest in sovereign debt, in banks, in hedge funds needs to be significantly increased. And the role of the rating agencies should come under great scrutiny, in my view, since they did not play a particularly productive role in anticipating the problems that arose in Greece. As I look ahead, there are bigger issues as well, of course. Europe has made virtually no progress toward a fiscal union. And as all of those on the call this morning know, when the euro was initially conceived by leaders such as Helmut Kohl and French leaders at the time, it was conceived as a common currency alongside a common fiscal policy. The efforts to further integrate European economic and financial policy seem to have stalled over the years. And Europe faces today, as you point out, numerous other challenges, which understandably perhaps seem to be taking precedent. There is the challenge of rebuilding Europe's military, the challenge over the last years of coping with COVID, coping with an immigration crisis, coping with the energy crisis, which has beset much of Europe over the last 2+ years. None of this, however, should deflect from the necessity of strengthening the underlying fabric and coherence and sustainability of the Eurozone, if in fact the Eurozone is positioned to withstand another sovereign debt crisis. I think one of the lessons I learned during my many years at the Treasury is that no country is immune from a sovereign debt crisis. Many people think that the United States is. Many people may think that France is too large to have such a crisis. But if you look at the numbers today, in many major advanced economies, they are very, very worrisome. It's been quite a long time since we've had any fiscal discipline in the United States. And frankly, if you look at the numbers in France or even Italy today, notwithstanding the fact that Italy has brought down its fiscal deficit this year, the debt to GDP numbers are worrisome. In the United States, publicly held debt has now passed over 100% of GDP. In France, it's well above that figure, I think around 110%. And in Italy, it's well above that as well. I think these numbers don't define, of course, the entire situation, but one never knows quite when market confidence can be lost by a sovereign debtor. What will precipitate it? In the case of Greece, it was the successive announcements in the fall of 2009 that their fiscal deficit wasn't 5%, it wasn't 8%, it wasn't 11%. Well, when the full fact came out, it was close to 15%. And this froze private market support. I do not anticipate such a disruptive series of announcements in the future for any country that I just mentioned, but I do think that it's rather foolhardy for countries to think that they can continue to run sizable fiscal deficits and accumulate sizable debt to GDP without there being eventual consequences. I'll stop now, Desmond, and throw the ball back to you and the other distinguished participants. Thank you very much.
Thank you very much. Before I ask Mr. Russier to make comments, might I ask you, how do you see markets right now when what they're doing with Italy is, even though that country has a budget deficit now over 7% of GDP, a debt to GDP level higher than it was at the time of the 2000 debt crisis, about 140%. Yet what the market is doing is they're narrowing the spread between Italian and German bonds is now only something like 130 basis points. Do you see sort of parallels? Have the markets learned anything? This looks like it's the same sort of situation with a large country, 10 times the size of Greece, is running that kind of very poor public finances that are clearly unsustainable. Yet, the market seems to be buying these bonds, just stretching for yield. Is this a dangerous situation that we're setting ourselves up for?
Well, Desmond, I think you correctly point to the risks involved in these developments in the markets. My experience dealing with markets and related policy that feeds into markets is that markets can behave like Rip Van Winkle for years. They can be asleep. They can fail to capture the fundamental risk elements that are growing in the weeds in a particular sovereign country. And then something happens. It can be a change in the rating agency classification. It can be a major new correction of fiscal numbers, as in the case of Greece. It could be a geopolitical development. And it suddenly forces markets to focus in on the vulnerabilities. And at that point, life can become exceptionally difficult and tempestuous. And so I would suggest that even though it's not a perfectly parallel situation, that you point to what I think are very real risks here. And I'd be very interested in hearing our distinguished colleague Pier Carlo talk a bit about the Italian outlook.
Thank you, Charles. Thank you for those comments. And once again, thank you for alerting us to your book, which really bears reading. It's my pleasure now to hand the floor to Mr. de Russier. And I just should mention what a pleasure it is to see you after all of these years. And you bring back very good memories of my time at the IMF when you really had to deal with really very challenging issues. So I hand the floor to you.
Thank you very much. And I am particularly touched by your personal remembrance. Those were the years. I will make 3 points as briefly as I can. Firstly, the debt problem in the Eurozone has worsened over the last years. In spite of valuable adjustments, notably in Poland, in Portugal, in Spain, and in Italy, where primary surplus has been built up for the years, in spite of these efforts, the situation remains very threatening and worse than it was. Firstly, the from the end of 2013, as the European economy recovered from the recession of 2011 and 2012, the European Central Bank's monetary policy was made very accommodative. Quantitative easing was introduced, and from 2014 to 2020, some 2.6 trillion euros were bought by the central bank in terms of private or mostly public bonds. So that's the first idea. When you ask me about the future debt crisis, I like to look at the recent evolution. And I must say that it is worse than the situation you would have asked me a few years ago. The second thing is that monetary policy allowed a very big expansion of credit, and I would say an uncontrolled expansion of credit. From the end of 2018 and 2023, in 5 years' time, Italy increased its public debt by 24 points of GDP, Spain by 70 points, and France by 40 points. Now, these are not small evolutions. They are very, very potent figures. My third point is that these public debt figures are daunting. As Charles said a minute ago, now we have at least 3 major European countries, France, Spain, Portugal, Italy. We have 4 of them that have public debts that are higher than 110% of their GDP. And so it's a textbook matter that we are living in. We had a very lax monetary policy, which entertained 0 interest rates in real terms for some 15 years. And this facilitated an enormous increase in the debt of the public financial system and an enormous increase of credit. Now, when you throw 0 interest rate money to a situation where borrowing by governments and by private agents is rising very fast, you have all the reasons to do 2 things. One is to create an inflationary environment, which happened. And the other thing is to increase indebtedness. Because if you ask a minister of finance not to borrow and to adjust when interest rates are in real terms at 0, he will laugh you out. So that's the basic situation. Now, the second thing is that the Commission, that is the executive branch of the European zone, has been powerless and voiceless in front of the deterioration, I would say the massive deterioration of indebtedness in the Eurozone. We have 2 benchmarks that are fixed by the Growth and Stability Pact. One is that the budget deficit should never exceed 3% of GDP. And the second one is that the public debt should not exceed 60% of GDP. Now, if you look at France, for instance, the last deficit, the one of 2023, is going to be higher than 5%. And the public debt, as I said, is 110%. So these 2 rules are completely violated, and not only by France, but by, as I said, a number of important countries. Now, the new Stability and Growth Pact is full of good intentions because it sets a dialogue between the country that is erring and the executive branch of this monetary system, which is the Commission. So it's always good to have a dialogue. The second thing is that if the dialogue leads to the notion that the country is over-indebted and overextended in public financial terms, then there is a procedure to get through an adjustment process. And the adjustment process in this new version is centered on two things, which I think are valuable. One thing is that you should survey particularly the expansion of public expenditure, which is usually at the root of a budgetary problem. And secondly, there is a sort of a simplified view whereby if you are in a budgetary position deficit-wise that is significant, then you have to decrease your public debt by 1% a year. It's a rather, I would say, basic view, but it has a good intention. Now, unfortunately, the rule is full of exemptions, and one exemption is very strange because it's an exemption that is counter, I would say, counter-rational. If you have a deficit of your budget that is higher than 3%, the limit that you should not expand, if it's higher, then you can forget about the rules that I was indicating on the reduction of public deficit. I fail to understand the logic because this is counterintuitive. It's as if you said to a pupil, well, if you have very bad marks, you won't be subject to the constraints and regulations that we have for the bad pupils. So this is something that, of course, annihilates the sting in this new system and makes it very, very ineffective. And lastly, that's my last point, what is the future? Well, I have to remind ourselves that in a monetary union where individual countries cannot devalue, they have to see to it that the level of expenditures is consistent with the level of expenditures of the other countries that are competing on the market. Because if they don't do that, they will see a deterioration in their competitiveness. So my simple view is that if we do not act to restore some viability in public finances in the four countries which I was centering my remarks on, if we don't do that, we are going to roll things over, as we always do, but in a more intractable position than we used to. What will be the future of the Union? I do not know. But one thing is sure, the big investments, climatic, energy-wise, that we have to consider, and they are enormous. They are in the order of 5% of real growth per year. These real investments cannot be financed by money creation. They cannot be financed by the public sector because the public sector has no money to spend on those things. So it will have to come from private savings. And private savings are there. They are sufficient to finance the 5% extended expenditure that I was speaking of. But as long as the public finances in Europe are so bad, as long as the ECB will consider indispensable to keep interest rates, that is the return on savings, to keep interest rates as low as possible and lower than it in the dollar zone, we will see the leakage of long-term savings from Europe, where they are needed, to the United States, where they are less needed. And this is something that is difficult to understand. Why is Europe so desirous to have an active capital market union whilst it keeps interest rates systematically lower than in the United States? Thank you for your attention.
Thank you very much, Mr. Rocher. You articulate really well, the concerns about the public finances. But you mentioned a point as well that these countries don't have an exchange rate, so they don't have an independent monetary policy. They're stuck in the euro. So does that not create a huge problem that if they really want to address their public finances through budget belt tightening, that might produce a recession? Was that not something we saw, in the 2010 crisis? They've got themselves into a really very difficult situation. The normal thing for a normal country, if they're not in a monetary union, is they would do the fiscal adjustment and devalue the currency, so there'd be an offset from the export side or from the traded goods side, to balance the budget tightening. But, when I just look at the numbers, when I look at Italy with a debt level that's the highest in its history in relation to GDP, and yet it's got a budget deficit of 7%, and the economy is not really in a recession, I'm not sure how they get out of this mess.
Yes, this is an interesting question. I think we have to avoid too simple a format to answer it. I have spent a lot of time on that question that you rightly raise. The fact of the matter is that in a country like France, for instance, you have public expenditures at the height of 60% of GDP, whilst the average in the European zone is 50%. So we have a sort of a excess of public spending that is in the order of 10 percentage points of GDP. It's enormous. Normally, it should be, if you have a Keynesian view, which is behind your view, you would say, well, this is going to expand the economy of France. If you look at it in a micro way, you start working on the nature of this 10% more spending in France than elsewhere. And what do you see? You see that that spending has nothing to do with growth. It's a little bit a spurring element for demand. But if your economy, in terms of economic output balance, is too rigid and cannot, in a way, host the excess demand that you are creating through that budget, what happens? Deficit of the current account. And that's what we have. Now, a deficit of the current account is not spurring demand. It is spurring demand in Germany, but not in France, because the cars that we are importing are made in Germany. And I have calculated that we have been losing over the last 20 years 2.5 million employees in the exporting area, which has shrunk, and we have made the Germans benefit in a way from that system. So you have to be careful. Yes, public deficits look like favorable to demand, but in fact, they're not that favorable to demand. They are more favorable to demand in the other countries, which will be expanding their exports. Now, I have proposed to the government, who is not listening, of course, I have proposed a very simple system. I say, as long as we have 10 percentage points of GDP more public expenditures than exist in the average of Europe, it's much less in Germany. As long as we have that, we are not going to be competitive enough to maintain our position on the balance of payments system. So I say, let us reduce this 10 percentage point by, let's say, 1% per year, which is in IMF terms, as you know very well, not something extraordinarily demanding. And if during 10 years we were to reduce not social demand, not social expenditures, because those are sacred in France. If you touch them, you're going to have a revolution. But if you keep them, you keep the public socials part, which is more or less 50% of the total expenditures. If you say, okay, I'm not going to touch the 0.5% of that 10% excess, I'm not going to touch such social things, but I'm going to touch the non-social things. And if you look at the budget, chapter by chapter, you have to, it's a very delicate work. It's a research work. If you look at it, you see layers of public demands, public expenditures that have been piling up over the last 50 years, not 10 years, which, if you consider them one by one, are sometimes useful, sometimes innocuous, and sometimes completely wasteful. The completely wasteful, I say, get rid of them. And if you did that, you would bring your 60% public expenditures to 50%, which is the level of Europe, and then you wouldn't have corrected everything, but at least you would be in the intellectual framework of the European zone, because the European zone is a zone where you don't bail out the poor performers. On the contrary, you don't bail them out. You have to keep them responsive. And I say, if we started that 1% per year reduction in useless expenditures, non-social, you would not have a French Revolution. You would have an improvement in the quality of the standing of France in a system that forces everyone to have a relatively normal, quote unquote, economic policy. So I'm proposing that it's feasible. I've worked on it with great specialists of public finance, but nobody listens, of course, except you, because you're a friend.
Well, thank you. That really makes a lot of sense. But I kind of just wonder whether you've got the 10 years, whether the markets are going to give you that long to bring things back into order. That it seems to me that what's kept matters afloat has been that the ECB's been buying these huge quantities of bonds, which that too is not sustainable. So I think that there's a time issue, that, like Charles says, is that suddenly risk appetite can change. Markets can then begin to focus and say, this is really not a viable situation. This country doesn't have the 10 years. We're not going to give them, we're not going to be financing them for that period of time. But
yeah,
let me...
No, I respect very well what you say, and I must say that half of my heart is on your side. But I also note that Sweden in the 90s, in 15 years, more than 10 years, reduced its public debt by 40%. So I'm only looking at 10%, so in terms of GDP. So yes, you are right. Perhaps the market will not give us the 10 years. Perhaps it will. And I'm trying to hope on the second part of the sentence.
Yeah, I had the fortune of leading the IMF missions to Sweden in 1992.
Well, you did a good job.
But the point in Sweden is they let the currency go, that the currency depreciated by something like 30%. So it was really a textbook case that what they did was they did the fiscal tightening, and they had a real exchange rate, a very big exchange rate depreciation. So the whole thing worked out, and they dealt with their banks in a sensible way. It was really, but they had the luxury that the countries in the Eurozone don't have, in that they had an independent monetary and exchange rate policy.
Yeah, but in a way, you've answered your own question, because what you say is that without an exchange rate that reacts to macro policies, you can't make an adjustment. And if you say that the Eurozone is not viable. Because you have several exchange rates. The south of the region, including France, has a lower exchange rate, a more depreciated exchange rate. The northern parts, excuse me, I was mistaken. Germany, Austria, Netherlands have an exchange rate that is softer than the one they would probably have if they were navigating on their own figures. And we have the contrary. We have a currency that is a little bit higher, goes in the sense of Sweden. And we like to have a currency that is a bit higher because it's good for domestic demand. We are afraid of too strong an exchange rate. So the system works like that. The Germans are happy because they have a softer exchange rate than the one they would, which facilitates their export strategy. And we have a higher exchange rate, which facilitates the non-impoverishment of our population. But it's not a very good system. It's a sort of a horse trading system. And I say that if you do the basic thing, which is to reduce excessive public expenditure. I mean, that's something that's always true. And it's true in your memory of IMF working. If you do that, at least you're okay on that chapter. And we'll see what the exchange rate will do. It could appreciate. I don't know. If you continue to have a lower interest rates in Europe than in the US, it will not appreciate. So the big mistake is to keep with obstination our interest rate 1 percentage point lower than the US. It's a big mistake, but it's very difficult to make the ECB understand that, because probably it's a bit too complicated.
Thank you very much. Let me see what Professor Podawan has, what light he can throw on the questions we've just been discussing.
Good afternoon, and first of all, thanks very much for inviting me to this exciting conversation. It's really a pleasure and a privilege. I'll try to come to the issue of, well, speakers raised the issue of Italy many times. And I'll try to say something, but if you allow me, I wanted to take a more general approach to the question of this seminar. That is to say, is there going to be another crisis? And therefore, the issue of crisis in the monetary.
You've got Professor Podawan, we're not hearing you. We're not hearing you. We see you, but we don't hear you.
Well, I don't know what,
no,
it was
that's
working
fine.
nicely before.
Yeah, it's
Can you
working
hear?
now.
It's working now?
Yes.
Okay, so did you hear anything of what I said, or should I start again?
If you start again, that would be good.
Okay, well, very quickly. Thanks for the questions. I wanted to, first of all, talk about the title of the seminar, which is to say the role of crisis in the monetary union. You can look at the crisis in monetary union from at least 2 points of view. One is that if they happen, they are signaling a failure in the system. Number two, if they happen, they may open opportunities for improving the system and improving the institutions which are needed for the system to operate. And my point is that both of these elements are still playing a role in addressing the issue of what will happen to the Eurozone and to maybe weaker countries within the Eurozone. But first of all, if there is a crisis, that signals a failure. And a failure implies not only, as in the very nicely, I had the privilege of looking at the slides that Athanasius sent us, not only the very nice modeling of monetary policy role in crisis, but I would also like to draw the attention, obviously, to the role of the fundamentals that played in the crisis. By fundamentals, what I mean is basically macroeconomic imbalances. Let's not forget that if you looked at the macroeconomic imbalances distribution in the Eurozone before the crisis, you would clearly see a distinction between the northern countries running surpluses and the southern countries running deficits, which meant that they were kept together by a structure of capital flows, which eventually proved themselves to be unsustainable. So that is a fundamental problem which needs still to be addressed in a satisfactory way. That's why I'm worried. The ECB can make all the mistakes. Excuse me, what is it? I'm sorry, I'm in a hotel in Paris and they're knocking at the door. As I said, the issue is what do we do with the imbalances in the Eurozone dealing with current account imbalances and the counterpart, which is the saving investment gap, which also covers the role of public finance, which we have been just discussing. So my first point is, let's look closely at why these institutions these evolutions are developed and what they do. However, I just said that the crises are also opportunities. And indeed, if you look at the economic history of Europe after the war, you see that accelerations in institution building and improvement have been sparked off by crisis. And they've been sparked off by crisis with an important element of distinction. The way the countries or the union exited the crisis, agreed on something, was usually most of the time, if not all the time, towards more integration, not less integration, with some obvious exceptions, which is Brexit, and one possible exception, which is Greece, which unfortunately did not happen. So the way the Europeans looked at the crisis as a motor for change was to use the crisis as an instrument of deeper integration. There are many examples, but the obvious examples are, of course, the sovereign crisis you've been discussing about Greece, and Jacques has been discussing right now, the COVID crisis, which led to the establishment of the Next Generation EU, but even the very introduction of the euro at the end of the Bretton Woods flexible exchange rate sequence and the starting off of the one market, one money program shows that crises in Europe have been detonators of adjustment, which sometimes is important, other times is half complete, but it's still there. I think Charles Allara mentioned banking union at the beginning. This is a case of setting up a very important institutional setup, instruments to deal with the flaws in the system, have both governments, public finance, and banking sectors get out of the famous, unfamous doom loop, which linked budget balances in the public finance sector with the balance sheets of the banks, which eventually financed those that budget deficits and generated a fragile system which eventually exploded. I don't have to tell you this. This is very well known. So the point that I want to come to, and I hope I'm not using my time already, is what is the lesson we draw? Does that mean that in order to make progress in institution building in Europe, we need a crisis? That would be, of course, a tragedy, because I don't think we need a crisis. However, we don't need a crisis. Oh, there's the full picture now. But we also don't need no change, because we are stuck in the middle of a river, so to speak. Banking union is not making progress. Capital markets union is not starting. We need both those instruments in addition to others, in addition to next generation EU, to spur growth in Europe, and especially in the southern economies. So we need to find a way to make institutional progress without a crisis. That is the deep challenge we're facing today. And what can we say about this? And this is my last point. Well, we know from history of international cooperation and institutions that whenever a multi-country institution is set up, that is to say, when countries are agreed to set up a collective action program which keeps them together facing a common threat or common opportunity, there are conditions under which this can happen. Let me briefly list them. There are 3 or 4, the most important one. First of all, preferences in countries must be aligned, they might be getting closer together. One example, preferences for public finance should be all across the board in all countries, not just some countries, for public finances, sound public finances, not in just countries. Second condition, which was already mentioned, you need a long time horizon to do that, because only in the long time the benefits from reform show themselves and beat the evolution of costs of reforms, which are usually front-loaded, which are usually short-term. So we need to have an incentive for governments to continue in their activity, reform activity. They need to take into account new challenges, and certainly, unfortunately, we need to take into account security and green growth and digital revolution to face both the security challenges and the opportunities of new sources of growth to productivity shocks. So I think I'll stop there. To reiterate my point, crises are an important element of economic history in Europe and elsewhere. Sometimes countries and governments have felt the punch of the crisis without being prepared. In other situations, they were more prepared or more able to deal with the crisis. We must make an effort to build a system which allows for crisis to be managed and taken as an opportunity. Thank you very much. I'll stop there.
Yep. Thank you very much for those remarks. I wonder whether you could say a word or two about how you see the Italian situation, that we've been touching on, specifically, do you see this as a sustainable kind of situation, running these kind of deficits with this kind of debt level? Or how's this all going to work out with the ECB now not buying their bonds?
Well, first of all, yes, this is a very appropriate question. Let me say that the question which in Italy, in the economic policy debate, is often raised. Why is it that in spite of over 140% and the deficit, which is a sizable amount, markets don't care, seem to be comfortable with the Italian public debt? And this is what happens if you talk to business people. Business people are concerned more about the real side of the economy, and they're quote unquote comfortable with the fact that financing conditions are useful and more or less adequate for financing investment. One of the big good news of the Italian economy recently is the fact that the real sector is doing better than usual. So there is a relatively higher growth rate, which at least for the time being, offsets the interest rate, which eventually will raise in its level. Will this last? No one knows, but I tend to share the views of those that this is mostly politics. Indeed, one thing must be recognized, that the current government, which is a center-right current government, is very solid. And political stability is something which Italy has not enjoyed all the time. And this is something which I think markets are taking into deep consideration. Having said that, there is another element which I'd like to draw your attention to, that Italy, together with Spain, is the highest beneficiary of the so-called Next Generation EU program, which is a huge program to boost growth through public investment, structural reforms, and the possibility of issuing European debt on the markets, so that that burden for Europe is less than what was expected. So there is a combination of factors that point to a better evolution of the Italian economy and economic policy than expected. Will that last for long? That's a big question mark. So far, however, the political system is at a standstill, and though there is no rush to accelerate change, we will have to wait the European Parliament elections, which takes place in a few weeks' time, to see whether the political balance has been changing or not.
Yep. Thank you. Just before I turn to Athanasios, might there be similarities between what's going on in Italy right now with what happened in Greece in 2009? You know, in 2009, markets were quite happy to finance this country, you know, until they weren't. You know, so aren't we in a similar kind of situation, except the numbers are a lot bigger? You know, that's we're talking about an economy that's 10 times the size of Greece, and that the financing can stop for any sort of reason. You know, if we have a real estate crisis in the United States, that could be a trigger. If there's a war in the Middle East, that could be a trigger. You know, there could be just so many triggers that can change the flow of funding. You know, the way I see it is that what was helping Italy over this whole period was that the European Central Bank was effectively buying the whole of Italy's net debt issuance. You know, so once that stops, you need the market financing. And, you know, it's the question of what Rudy Dornbusch used to say about crises taking a lot longer to occur than you thought. But when they occur a lot quicker than you would have thought.
Well, first of all, I think that one should ask the ECB why do they do this, and do they think they're doing the right thing? Evidently, they are. But my point is, apart from monetary policy, which of course is helping Italy and is helping the rest of the Eurozone, is helping the fact that the Eurozone is now split into two parts, the South and the North. So there is a need to adjust that fracture in a structural way. But there are some differences, and Athanasios can correct me if I'm wrong. At least in the case of Italy, the situation of the banking sector, in spite of fragilities, was sounder than the system in Greece. And there was a growth rate, which after all was a bit better than the system in Greece as well. Public finance was also a problem in Italy and in Greece, but as you said, as yourself noticed, the numbers have been worse for Greece than for Italy. Is this the same situation today? I applaud the Greek government and authorities for obtaining very good results very recently. And then, if you allow me, I would like to hear from Athanasios now, whether they think that the current policy for the government is the right one, and so we can agree that our respective governments are doing the right things.
Thank you very much. That's a good segue into Athanasios' presentation, which I look forward to hearing. Athanasios.
Thank you, Desmond, and thank you, Pietro, for inviting me to comment on this. I can comment on this and some of the other elements that have been mentioned, but let me first start with a few words about the topic, as you mentioned, avoiding another Eurozone debt crisis And I'm going to start by reminding us all that another Charles Whiplotz, 10 years ago, gave a lecture with the title, "The Eurozone Crisis, a Near Perfect Case of Mismanagement." And I mention this because reading through the fascinating book that Charles Zallara wrote, it actually reminded me of just how horrible the management of that crisis was. And with a blow-by-blow account of how that came about, the opening chapter, for example, highlighting that, well, when you're in a crisis, ideally, normal crisis management involves knowing who is responsible to take some key decisions. And in the opening chapter, we see, oh, there is this question mark about who exactly is in charge of resolving the crisis in the best interest of Europe. And the answer is nobody. And then reading through the book, we realize that as a result of the political vacuum that unfortunately was in place and still is in place in Europe, instead of having decision makers, a leadership structure that would resolve a pretty small crisis, I would say, when it was first there in 2009. Without having that, then the whole system disintegrated into governments of member states who had more leverage, ended up calling the shots and doing a very good job protecting the interests of their member states and their constituents, but that did a terrible, terrible job in terms of the euro area. And we're also reminded of how destructive the role of the IMF was at the time. But that's no surprise, because the leadership of the IMF at the time, as it had been since the Second World War, had been controlled by the same governments in Europe. So if we have a problem with the governance of Europe, we ended up, unfortunately, having a problem with the role that the technocrats at the IMF could have had, the very positive role that the IMF does have in helping resolve similar crises elsewhere. So what I want to do is spend a few minutes highlighting one of the issues that are not covered in as much detail in the book, and this is what is the role of the European Central Bank in the crisis that we've had a long time ago, and what is the role of the European Central Bank in avoiding the next crisis when this comes. And I hope you can see my slides, if you can confirm that, Desmond.
Yeah, the slides are showing well.
Very good. And I'm going to start with a question that really is segues with what Pietro was raising. If we look at government bond markets, what exactly determines the fundamental spread? What exactly is the determinant of the risk premium that governments are required to pay in excess of the safe rate when they refinance their debt? And of course, we know that fundamental factors come into play. But in advanced economies, we know that in advanced economies, the euro area member state fundamentals have not been worse than fundamentals in other advanced economies. And yes, we can see from this chart that since the euro crisis, there is something fundamentally wrong with euro area sovereign bond markets. Something is creating this volatile and occasionally very high risk premium that some euro area governments are forced to pay on refinancing their debt, and we don't see that in other advanced economies. And what I want to highlight is the role of the central bank's policy framework in this. In my view, we had a framework in the euro area that was working quite well before the euro crisis, and unfortunately, since the euro crisis, the ECB ended up being politicized, and the ECB has been adopting policies that are part of the problem. And what I want to highlight is the role of the collateral framework that the central bank has in determining whether a country ends up in a bad equilibrium or a good equilibrium among the multiple equilibria we have in bond markets, and how that can generate crises that would otherwise be avoided. Now, where does this come from? This comes from this unique characteristic in the ECB collateral framework. Governing Council of the ECB decided, and for the first time, threatened to enforce this at the beginning of the Euro crisis in 2010, which I consider the original beginning of the Euro crisis, this key ECB decision, to delegate the collateral eligibility of government debt to credit rating agencies. And of course, we know what this does. This is threatening to destroy the liquidity premium that government debt enjoys in all well-run monetary system, and this has been a source of instability in the euro area ever since. We can actually put an analytical background in this. On the chart here, you can plot the debt to GDP ratio on the horizontal axis and the haircut on government debt on the vertical axis. If government debt is eligible without any haircut, the haircut is 0. If the central bank above some debt ratio decides not to accept at all government debt as collateral, that corresponds to a haircut of 1. And this effectively becomes a cliff effect, very similar to the cliff effect that the ECB has hard-coded in its framework through rating agencies. So as we know, the ECB accepts government debt as collateral if private rating agencies, at the time, most of them based in the US, which was a very surreal thing, US private institutions were really determining the implementation of monetary policy in the euro area. And if there was a threat that ratings would be below some point, that would create the problem of bonds not being eligible and cause a rollover crisis. And indeed, you can show very easily that in this setting, where the central bank's framework can tolerate good equilibria and bad equilibria with high rates, you can actually have the framework become the source of avoidable crisis in the system. Very similar to what we actually have seen in the euro crisis and not seen in other advanced economies with similar fundamentals if we go back 15 years. So what went wrong? In my reading of the crisis, and I have to say, I was a member of the Governing Council in 2010, and I am willing to admit that the ECB was a major part of the problem at the time, something that is not acceptable by all who were there at the time. The ECB decided to use its power to threaten to declare government debt ineligible collateral in an ill-advised attempt to promote fiscal discipline. Of course, we know that it's very important to have fiscal discipline. The question is whether it is appropriate for the central bank to actually use its discretionary authority and threaten to create crisis, and whether this is a good thing for promoting fiscal discipline. Doing so opened up the possibility of multiple equilibria and actually pushed a number of countries in the euro area more than a dozen years ago into bad equilibria. It also heavily politicized the implementation of ECB monetary policy and weaponized one of the crucial political errors that were committed during the crisis that Charles Zallar talks about very nicely in his book, the Deauville Agreement, where you say if a country loses market access, what did Deauville tell to global markets? Oh, we're going to impose losses to holders of the government debt, regardless of whether debt is sustainable on the basis of fundamental analysis with low interest rates that are sustained. Now, why did the ECB framework weaponize Deauville? because the ECB framework effectively delegated to rating agencies the possibility of countries losing market access, whereas in other settings with other central banks, that would not have happened. And then we're off to the races. After Deauville, with a combination of the framework, we were off to the races. Now, do we know how important this is? And this is where I want to spend a couple of minutes on highlighting that, of course, we know how important this is, and the ECB knows how important this is, because the ECB showed us how useful removing this source of vulnerability from its collateral framework is during the pandemic. And the pandemic actually is a wonderful case study for understanding how the ECB can create crisis or resolve crisis before they materialize. So if we go back to March and April of 2020, we had a 20 percentage points or so spike in debt to GDP ratios. Here I have on the left the IMF's projections in October 2019 and October 2020. And on the right, I have spreads over OIS for Italy. What happened when the pandemic broke? Well, of course, we expected that there would be an increase in debt, and under the rules the ECB was operating at the time, that would have certainly created a crisis. And we see the spreads moving up. We see the ECB being a little bit in denial initially, not really clarifying what it would do to resolve the spreads problems. Then we saw the ECB do the standard trick. Let's announce a bond purchase program and see whether that resolves the situation. And you can see here on the right, the PEP was introduced on March 18, and it worked for about a week. And then it failed. And bond purchases do not resolve the fundamental vulnerability that is there in the ECB's collateral framework. Of course, the ECB realized this. They knew what the problem was. And on April 22nd of 2020, they actually suspended the role of credit ratings in the ECB's collateral framework. From that point on, and during the pandemic, global investors did not have to be worried that the ECB would cause an unnecessary crisis, because the ECB said that it would accept government debt as collateral regardless of what the credit ratings would be. And that resolved the crisis. You can see in the decision here, it was initially a suspension. In December of 2010, the suspension was prolonged until June 2022. And then, Desmond, this is going to be a partial answer to your question. Where are we now, and why are we facing similar problems now to the discussion we had before? Well, unfortunately, this is because back on March 24, 2022, the ECB decided that it did not really appreciate having the elimination of this vulnerability from the system, and decided to go back to the pre-pandemic collateral framework, delegating once again the collateral eligibility to rating agencies, and once again introducing the vulnerability in the system. Of course, we know what happened after that. We had turmoil in markets that is very visible here. And once again, in July of 2022, the ECB was forced to announce yet another purchase program that could be activated to calm the markets. So this chart summarizes what happens if the ECB removes the vulnerability. This is exactly at the time when the debt to GDP projections in the euro area were at the worst possible levels. Late 2020, early 2021, we had the narrowest spreads. And since the ECB has returned to its pre-pandemic framework, reintroducing the vulnerability that the ECB had introduced in the original euro crisis, we again see the spreads being volatile and widening. So when you ask the question, will we have another crisis? Well, we need to see what is the role of institutions in averting known problems that we have in the system. I ask myself the question, would we have had a crisis in 2011, 2012 if the ECB had operated following best practices of central banks in any other economy? The answer I give to that is no, we would not have had that crisis. Will we have another crisis coming up now that, as you pointed out, Desmond, the debt ratios are much, much worse, as Jack pointed out, and I fully agree with those remarks. The fiscal fundamentals are actually not that good. Is it avoiding the next crisis if the ECB makes the situation worse by injecting additional risk premia on top? So in the case of Italy, for example, to close with the question that Pietro led with, in the case of Italy, as Jack pointed out, we had primary surpluses. I was looking at primary surpluses for 20 years in the case of Italy, with interest rates, safe rates being effectively zero, and yet the debt to GDP in Italy rose instead of falling with primary surpluses. Why is that the case? Well, frankly, it's not a surprise. If the central bank is actually calibrating its framework so that Italy always faces premia between 200 and 400 and 500% basis points. Right now, we're down to 150 basis points. These are unnecessary premia that would not need to be there. But with those premia in place, then yes, we are making it much, much harder for governments such as the government of Italy to bring the debt dynamics under control going forward. So how do we resolve this going forward? Well, my view, we need to start with the low-hanging fruit. There are many gaps in Europe. We have gaps in governance. We have gaps with the lack of a banking union, financial union, and so forth. But we have low-hanging fruit. In the ECB, we have an institution that can simply use its discretionary authority in a much better way than it has used in the past and avoid being a source of the problem when the next crisis episode shows up. And I will close here and see where the discussion takes us.
Thank you very much, Athanasios, for that really interesting presentation. Before I go to each of the speakers and ask them whether they've got questions for any of the presenters, I just want to ask Athanasios a couple of questions. The first question is, how would one discipline countries to be more fiscally responsible? You know, you're saying that you don't want this collateral requirement, but then what stops the country, you know, from just running whatever sort of deficit it wants? You know, that's the first question. The second question was in terms of the spreads. I would have thought that those spreads are far too narrow considering the fundamentals. You know, that if you're telling me that spreads are driven by fundamentals, what is a country that is on clearly an unsustainable debt path doing, being able to borrow at 130 basis points over Germany? You know, that to me makes no sense at all. You know, that the only reason it's doing that is because, at least in my view, that they're banking on the fact that the ECB is always going to be there to buy the bonds, you know, so that when comes crunch time, the ECB will buy the bonds. So don't bet against the ECB because they'll do whatever it takes. But, you know, at some point that might not work. So I wonder whether you could just comment on those. So
let me start from the second question, and again, this is going to be a partial response to the challenge Pietro put earlier. You are assuming that let's say Italy 10 years ago was on an unsustainable path. Let's start from that assumption. And what I would call to your attention is that since we have multiple equilibria in government bond markets, it's critical to examine what is the cost of refinancing of debt that one should use to assess whether a country is unsustainable. Should that analysis be done with a market-based interest rate that already includes premia that are unwarranted, or should the analysis be done on the basis of safe interest rates that would have been available to the country if the central bank operated with best practices? And in my view, when we discuss sustainability questions, we should always ask the question, is the country sustainable with the lowest rates that the central bank can deliver? And in my view, if I take Italy 10 years ago, before the euro crisis, after the euro crisis, given the primary surpluses they were running, they were absolutely sustainable on that basis. But of course, if you do the sustainability analysis as adding a couple of hundred basis points or more, which, by the way, is the methodology that the ECB has adopted, unfortunately, flawed methodology to start from that point, then you will be concluding that the country's debt is unsustainable. Why? Because of the additional 2-3 percentage points that on average you have added to the cost of financing of the debt over the years. So this is one element. Now, I don't want to take away my agreement with the point that Jack highlighted. We do want to have more sound fiscal fundamentals going forward. I agree with that. I am more worried about the debt levels now, clearly, than what we had 12 years ago. But I don't want to use that as an excuse for the central bank to be magnifying the problem. I don't think that's part of the solution. Now, the second thing I would say relates to your first question. If not the ECB's imposing fiscal discipline through its collateral framework, then who? And frankly, this bothers me in the context of the democratic accountability deficit that we have in Europe. My understanding of the European Union Treaty and of the framework that we have organized as Europeans actually points to a much higher standard than that. We have rules. We have delegated responsibility to independent institutions like the ECB. The ECB should be in charge of delivering price stability. And I agree with Jack's concerns on that, but we can come back to that later on. The European Union Treaty did not delegate to the European Central Bank the authority to be the fiscal policeman of the euro area. As a matter of fact, the European Union Treaty is very clear that we have the European Commission and we have European government bodies and the other governments. We have the head of ministry, we have the heads of states, which do have the authority to sanction governments according to the rules of the European Union. Some say, oh, but this did not work very well, so why don't we just hijack the system and ask the ECB to do the dirty work for us? Well, look where that got us. That actually got us into having avoidable crisis. And I do not think, as a European, I do not think that this is the best we can do in Europe. I think we can do better by respecting what has been written in the treaty and by asking those institutions that are responsible for monitoring governments and encouraging fiscal discipline to do their job, instead of relying on creating crisis as a disciplining device.
Okay, just before I ask Charles to whether he's got any questions on the other panelists, you're not suggesting that Italy's debt is sustainable, that it's just a question of the spreads, because I would have thought you might have said that we're now moving from a world of ultra low interest rates. The ECB had negative interest rates for a long period of time. That made the debt more sustainable than it actually appeared. Yet you look at the numbers aren't too good. Even with those ridiculously low interest rates, you've still got a budget deficit of 7%. You've still got a debt level of 140%. I would have thought that, forget about the spreads at 130, that's not really the issue, that the country's really now going to have to finance itself at much higher interest rates. And this debt is, you really just can't run these kinds of budget deficits. But let me perhaps pass it on to Charles, and you can come back to me if you want. Charles, would you like to?
Perhaps, thank you very much, Desmond, and perhaps a few comments and one question after these fascinating presentations by our colleagues this morning. First, let me pick up, if I may, and try to maybe create some threads among the different comments that we've heard this morning. First, I think I'd like to start with Pierre Carlo's point that periods of structural integration and reform in Europe have often followed crises. It is true, but I don't see the compelling evidence that coming out of the Greek debt crisis, which was, after all, a broad Eurozone debt crisis. It wasn't just Greece, as we all know. In that vortex of instability there for 2 years was Greece at the center, but Ireland, Portugal, Spain, Italy. And coming out of that crisis, I did not see, and I still don't see, the kind of leadership and movement to address some of the underlying weaknesses that we've talked about. The banking union has made some progress, but it's still languages. Capital markets union, the same, maybe even weaker. Fiscal union, no evidence of movement. And so I worry that why, I ask myself the question, why is that? And I think it's partly because Greece bore a disproportionate share of the burden of adjustment. Did Greece need to go through major fiscal adjustment? Absolutely, there's no doubt about it. But here I pick up on Jacques' point that fiscal adjustment needs to be moving in the right direction in order to gradually rebuild credibility. But it doesn't have to happen overnight. And I think what Athanasio's point underscores is that the central bank's collateral policy, the ECB's collateral policy, actually reinforced the need for what turned out to be, and many of us could see it at the time, excessively abrupt and rapid fiscal adjustment in the Greek economy, which drove the economy into the ground. And I think that the IMF and Commission have both acknowledged this in their own postmortems, but they do not seem to have built that into any lessons learned, Desmond, and this worries me. Greece went through a recession, which actually was a depression, the likes of which no other advanced economy has undergone since World War II, to put it quite bluntly, and it's still recovering. I do congratulate the Greek government today because with this political stability, and I think it's in some respects similar to, but even stronger than the political stability which has descended upon Italy in the last year and a half or so. I think with this political stability and some very sensible economic reforms, Greece has rebuilt its credibility, as indicated by its selection as 2023 Country of the Year by The Economist magazine. There is still a lot of work to be done, and there's no doubt about it. What I would come back to is Jacques' formula that in France and in other countries, what needs to be established is a pattern of fiscal discipline over a period of years. And here's where I would suggest, if I may humbly suggest, an answer to Athanasio's question is it really the role of the ECB to do so? I would agree with him fully that it was a mistake to hinge their collateral policies on rating agency decisions. As one former board member of mine at the Institute used to say, rating agencies are very good at arriving on the battlefield after the dust has settled and shoot the wounded. And that's, of course, I think what they did in the case of Greece, because the downgrades all took place too late and the upgrades have taken place also a bit too late. The point is that the collateral policies really exacerbated the problem here. And I think that the role really needs to be examined of the Commission and the IMF. What is really to prevent these two institutions from taking more forceful action to encourage strongly fiscal discipline at an earlier stage before it gets out of control, as it did in the case of Greece, and as it eventually may in some of these other countries, such as France and Italy? It takes a bit more of a stiff spine. It takes a bit more institutional strength, but it can be done. And earlier warning signals, you and I both know that the IMF has for too many years sent soft signals into the marketplace at a time of fiscal mismanagement for fear of encouraging or catalyzing a crisis. This strategy really doesn't work, and I would encourage a more forceful role of the Commission and the IMF at an earlier stage in fiscal laxness in order to avoid some of the problems that have developed and in order to avoid a crisis ballooning out of control.
I'll call on, thank you. I'll call on Mr. de Rozier to comment, but perhaps if I could ask him particularly to focus, what Charles has just said about the role of the IMF. I would have thought that the IMF really does not have much leverage, in a case in which the countries aren't coming to borrow from the IMF, that it would be more the Commission or more the ECB that has to be doing that kind of work. But I'd be curious to hear what Mr. de Rozier has to say.
Yes, I'm a bit far away from these problems now, but I believe that the IMF has a very important role to play, even if it has lost some leverage in the international monetary system. And the role that it can play is to assess this notion of sustainability of the public debt. Because it is a technical problem. There are a lot of hypotheses that you have to take care of, but still, it's something that an institution like the IMF can do and does pretty well. I was shocked, by the way, when Charles de Lara started his private-led effort on Greece. I was shocked that the IMF immediately participated in the Troika, that is, in the group of lenders to Greece, without putting a condition to that, which was satisfaction on the report to be made on the sustainability of the Greek debt. They entered this participation without the intellectual benefits of sustainability of debt, which is, of course, absurd, because you can't start an operation of restructuring of a debt without knowing more or less the sustainability of what you're going to restructure. I mean, it's very obvious. And it didn't happen at the beginning of the case that Charles took over. And no, I think the IMF can be a very useful agent in terms of studying the sustainability. Now, why did the European institutions, the Commission, the different members of the board of the ECB, etc., why didn't they want this sustainability study to be made? For a very simple reason, because they knew very well that the Greek debt was not sustainable, and therefore that the money that they had already loaned to Greece was under question. And that meant that in budgetary terms, they had to recognize a debt, deficit, and a loss. And the governments don't like to recognize losses. They like to roll on the problems, but not to call a spade when it comes to debt sustainability, because then you have to make a budgetary decision, which is to count down your assets. So I think we have to pay tribute to Charles in this thing, because he navigated through the positions of the IMF and the European institutions which didn't want to call a spade or renegotiation. And he navigated through that, and he obtained eventually from the private sector and no loss from the public sector. He obtained a very handsome and significant operation of restructuring. It's one of the most accomplished facts that I know of, where it is the private sector that pushed the public sector into, I would say, a reasonable restructuring. And I think he deserves great praise for that. Now, on Mr. Orfanides' indication, I was not aware of what he has explained. I think it's a technical mistake by the ECB, because intellectually, if you start when you are a central bank by saying, I will suspend my aid, my buying of those bonds, if the private sector debt for private sector institutions reduce the quality of the debt, it's by definition you enter into the crisis that you would like to avoid. I think his point is very well made, and it would not shock me at all if the ECB would erase that, would get rid of that thing. But of course, it doesn't solve the problem, because a spread is a spread, and the spread is the notion of the market that a country doesn't go very well, and that, of course, has to be accepted. It's true that spreads are relatively limited in terms of, you said it very well, of the ECB experience. So be it. But the real problem is a sustainability problem. And I am worried to see so many countries of Europe move into the unsustainability field. We have to deal with that. As I said, I think we can do it gradually. We don't need to make a big recession act of that. We can do it gradually. I'm sure that there's a lot of waste in public expenditures that can be gained, can be saved, and my notion is very pragmatic. So thank you, Mr. Orfanides, because I think you put your finger on a technical mistake, actually. But if you withdraw this rather bizarre being subject to the external view of these agencies, if you eliminate that, as you rightly demand that, you're not going to eliminate the problem itself, because the problem is there. It's the sustainability of the debt, and I am very, very flexible on this, because I believe, for instance, that Italians' external debt is relatively limited, because most of Italian debt is subscribed by residents, by Italians who like it, and are not, as Mr. Badawan rightly said, are not concerned about the figures of very high debt. And so, in fact, a country like Italy, which has worked through a positive primary balance for years, in a way has stabilized, not completely, but has stabilized in part the crescendo, the move of the public indebtedness. It's not a perfect situation, but it's less acute than in some other countries, where the debt is more held by non-resident hands and where there is no primary surplus. Italy has shown that primary surplus was something which is now much less in Italy, but still, it has shown that it was believing in that element of stabilization of debt. So we have to take into account all these things, and I think the meeting is very useful because you are raising points that are in a way very different from each other. Greece is not Italy. Italy is not Spain. France is worse than I would like it to be, and you have to. It's a case by case notion that Charles knows very well because we built that in the early 80s. We said, Mexico is not Brazil, Brazil is not Chile, and we're going to make a case by case treatment of all these cases. And I think it's the right way to do it, and you're doing it today. So congratulations.
Thank you. Professor Paduan, would you like to comment or raise any points, or particularly would you like to address the issue of sustainability in the Italian case? And perhaps, I just wonder whether you share Mr. de Rossier's view that the fact that the Italian debt, a lot of it's being held privately by the Italians, is a mitigating factor. I would have thought, though, that the Italian debt is being held largely by Italian banks, so we might have a doom loop in the banks, that the Italian banks are holding assets that aren't very, very creditworthy, that this can get them into trouble.
Oh, yes, thanks very much. Let me answer on 2 points on Italy and 1 point on Europe, more generally, if I may. First of all, I'd like to check technically, do you hear me and see me?
Yes.
Okay, because I'm not sure anymore that the system is now correctly working.
No,
but anyways, on Italy, first of all, on your last point, yes, it's true that most of the Italian debt is held by Italian residents, and that a large part of that, in turn, is also held by banks. But the amount of holdings of Italian public debt is decreasing, has been decreasing recently, and this has been going into the hands of the private sector households. Indeed, the latest issuance of short-term debt by the Italian government has been covered by many times over because of the fact that Italy was doing apparently not so badly in terms of growth with respect to other European countries, and the stability of the government was also an important factor. Point number one. Point number two, if you ask me what is the ultimate problem of debt sustainability for Italy, I would say it's growth. It's not there. Growth has been declining for a number of structural reasons, and Italy does not seem to be capable to get out of this debt trap. And you can run very generous primary surpluses, and you can benefit from low interest rates. But if your growth rate is not enough, you're not going very far. And this is a structural problem which is up to the government to solve, not the ECB. ECB has nothing to do with that. Number three, Charles said one thing about my point that crisis in the European experiences generate reform. And he said he's not convinced, saying, look at the banking union. Yes, it was launched, but then it's stuck. He's perfectly right, as often is the case. The banking union was initially the result of an institutional response. We need a banking union. But then there is a step two of the process, which is let's implement the new banking union. And this is where you see the obstacles. We all know that the banking union, which should have 3 pillars, hardly have 1.5 pillar, common surveillance and common resolution. It has no common deposit scheme, Why? Because there is a confidence problem that is lacking. There is lack of mutual trust in Europe as to have one single system covering deposits. So the famous point is that the German savers will never accept the fact that their savings might be used to save Italian banks' balance sheets. And from their point of view, they're not wrong, because there is a problem of trust, which has been constantly present in the management of the crisis, including the ones I personally went through. So in many occasions, the choices made by Italy turned out to be less effective because there was no trust in the Italian situation at large. Now, for a number of reasons, which it's not fully understandable to me, at least, trust is improving, although there is still a lack of trust within Europe. The reason why the banking union has not made progress is because national authorities or local authorities of different countries don't want to share liquidity, don't want to share capital, and therefore you cannot have a banking union if you have no full mobility of liquidity and capital, even within the same banking group, by the way.
Thank you. Athanasios, would you like to comment?
Thank you, Desmond. I would like to make one point on the theme that crises are opportunities. I agree with Pietro on this point, and the observation that Charles pointed out that but something has gone wrong since the Euro crisis. The European governments and institutions have not been able to use these opportunities as I think we agree could be done to improve the system more fundamentally. Has already been pointed out, half-baked ideas on the banking union that have gone nowhere and so forth. And what I want to point out is that if you look at this historically, I recall I wrote a short paper on this about more than 10 years ago. Crises were being used as opportunities to deepen the European Union from the beginnings of the European Union all the way to the Euro crisis. And the Euro crisis was the first major crisis where this did not happen. And I don't think that was an accident. That was the first crisis where we had another institution in Europe, the ECB, with the firepower to paper over issues without resolving them. And I want to remind you of a couple of the episodes that occurred early on in the Euro crisis. You remember the S&P, the Securities Markets Program? I mean, that was a disaster. But very, very few members of the governing council at the time actually voted against it. The vast majority supported the program. What did the S&P do in 2011 and then in 2012? It papered over temporarily through bond purchases the crisis of the day by reducing spreads by a few hundred basis points and leaving spreads a few hundred basis points more than where they would be. But in doing that, it eliminated the incentives that the governments had to actually make the fundamental reforms that were necessary to resolve the causes of the crisis, the lack of the banking union that was never adopted. Why would governments in the Euro area agree to go against the wishes of their constituents if every time a crisis shows up and they are forced to do something in the best interest of Europe, they can turn to the ECB and say, can you buy a few hundred billion bonds and just get us out of this and push the problem further out? And as long as the ECB is operating in this fashion, papering over small problems, we will not be using a crisis as opportunities. This is another example I want to highlight where, in my view, the ECB, unfortunately, has been a part of the problem, not a part of the solution. And if we are to avert the next crisis, which is the theme of the of the seminar we are having. I think it's important to understand what went wrong and what was the role of institutions that could have been improved in past episodes, highlight that and bring it to the fore and argue for changes that will improve future behavior.
Thank you, Athanasios. We've actually got two questions, from the audience, but I think that's one of the questions you've just answered. The question was, has the Eurozone monetary union failed to solve the problem of countries avoiding deficit adjustment by relying on the ECB? And if I understand you, you're saying that that is part of the problem. Let me just throw out, we've just got a few minutes left. There's another question. It is, what might be the impact on monetary and fiscal policies of increased representation by populist parties in both the Euro Parliament and the individual countries? Is that an impediment to fiscal adjustment? Does that complicate the story? Athanasios, if you want to.
Well, it's as a Rudy Dorbush student, I'm going to start by reminding us all what Rudy concluded about populism. If we really go down that road, we know that populism always ends in tears. And I hope we do not go down that road. But I have this optimism, I would say, that we have the European institutions in place to check some of the issues that would materialize. I don't think there is anything wrong with the public in a number of countries pointing out their frustration with the governance of Europe and the governance in their member states, which sometimes leads to populism. Yeah, frustration will give you that result. But we do have institutions in Europe that can prompt better fiscal governance. We do have some improvement on the fiscal council side, for example. We could have much more improvement in the implementation of how the European Commission lives to its responsibilities according to the treaty of monitoring governments and making solid recommendations to the ECOFIN and to the heads of states and governments on actions that would prompt governments to do fiscal adjustment. So that can't be done. It's in the word, it's written down. The question is to implement it. And we need to be careful when we do this. The fiscal adjustment, it should not be as destructive as what Charles pointed out was implemented in the case of Greece, which we know, it has been documented very well, that happened for political reasons in other member states. We don't want to be going down that road. We would much rather go the road that Jacques de la Rosière highlighted of limiting expenditures in a gradual basis. We have the mechanism to prompt governments to do this with the institutions that are envisioned in the European Union treaties, and it's a matter of asking those institutions to live up to their responsibilities.
Thank you. Let me give everybody a chance. We've just got a few minutes left for a last word. But I guess something that we haven't discussed about is how external events outside of Europe might change the European picture. And the reason I asked this question, or that I raised the question, is that in the United States, it looks like we're really on the cusp of a commercial real estate crisis that can cause a lot of problems to the smaller banks. That is one issue. And then we've got two land wars. We've got a war in Russia, Ukraine. We've got a war in the Middle East. That could have impacts. That could really change the whole picture. But, just with that brief remark, I wonder whether if I could start with you, Charles, and then we'll go in the order of the speakers. If everybody would just want a last word, you're under no obligation. If you don't want a last word, that's also fine. But let me start with you, Charles.
Well, I'll be brief, Desmond. I do think that the prospect of another real estate crisis in the U.S. is a real one, and that European financial institutions, both public and private, need to guard themselves and protect themselves against the potential transmission of this. As we all know, it was the transmission of our structured real estate credit in the 2007, 8, and 9 timeframe that brought the world really into a global financial crisis. Secondly, I am mildly hopeful that the hot wars, which are now surrounding Europe in some respects, to the south and to the east, but not so far to the east, right? An hour and a half flight out of Berlin, you're in the middle of a hot war for the first time in decades, will galvanize Europe. And I see some signs of this. Maybe those signs are small little buds of growth and need some fertilization. But I do think that Europe is circling around the challenge of boosting its military and at the same time recognizing that populist answers really are false answers. And I think that same thing goes for nationalistic answers here. Europe must bind together, and maybe during this time of threat, it could very well happen. I conclude on a final positive note about Greece. Greece flirted with populism for nearly 4 years in the middle of the last decade. And finally, despite the pain they went through, despite the fact that unemployment is still 11%, they said, you know what, populism really doesn't work for us. And they brought back a much more competent government. And I think we may see that happen again in other corners of Europe. Thank you very much, Desmond, for your leadership in this.
Oh, thank you, Charles. Mr. Dursier, would you like a last word?
Yes, I'm delighted to add my word. I think the real estate problem in Europe is more a commercial real estate problem. Now, I'm going to say something very simple. I think what counts, even in the external format that you have indicated, is that sound monetary policies and fiscal policies are always a plus. Mr. Padoan said rightly that the key to the indebtedness problem was growth, and of course I agree with that. But I would also add that Europe has been growing very slowly over the years, much more slowly than in the United States. And the reason why it is so slow and that productivity gains are so little is that productive investment has stagnated in Europe. And you have to ask the question, why has investment, productive investment, stagnated? And I have my own views on that. I believe that the orientation of our macroeconomic policies towards stimulating demand through monetary policy and zero interest rates was a mistake, because the future is growth and the future is long-term investment. And if you tell a long-term investor you're going to get zero remuneration, he's not going to come to projects. So it's essential that we restore a liberal system in terms of remunerating savings. If you tell savings that are destined to go in long-term projects, 25 years, with a lot of technological risks and things, if you say at the end of the road, you will have no remuneration, you're going to be laughed out. It doesn't work. And so I would like to just to say that if we continue to say, we're going to have 7 occasions to reduce interest rates, and we're going to go back to the nice zero interest rate, or very close to zero in real terms, if we say that, which we do say, not me, but many very estimate governors, if we say that, we're going to go exactly to the same problem of no investment. And no investment means that debt is not solvable. So please, be rational. Thank you very much.
Thank you. Professor Padoan.
Well, what can I say? When I ask myself, how do you see the world today? I see it as dominated by hugely tremendous and diversified set of shocks. There could be negative shocks like the war or the pandemic. There could be positive shocks when we look at the new technology related to AI. So what is the result of that? That policymakers and markets are probably confused of where the future lies. I continue to believe that you can think of crisis as positive accelerations of adjustment and growth. This is particularly true for Europe. I totally agree with Jacques de la Rosière on the key issue of productive investment and growth, especially at times of technological change. So basically, I am concerned about the situation, but I remain an optimist for the future.
Thank you. Athanasios, you've got the last word.
Thank you, Desmond. Just very briefly, because I realize we are also out of time, and I would wholeheartedly subscribe to what has been said. I will point out on an optimistic note that again, crises are opportunities unless an institution intervenes and squanders them, and the terrible war that we have in Europe in the last 2 years has created another opportunity. I do sense that there is a greater realization among the governments of Europe that it is in the common interest to deepen foreign affairs and defense policy that was totally outside of what the European Union was doing before. I am heartened by the fact that we have the broader Europe that includes the United Kingdom, that unfortunately is no longer part of the EU, that includes Switzerland, that includes Norway, that are working together in order to strengthen the role of Europe in world affairs and defending the values that Europe has been built on. And this gives me some optimism that the realization of what is important will take us back and say, why were we bickering so badly 15 years ago, nickel and diming everybody, ending up reducing growth, reducing per capita income for no good reason at all? We should deepen Europe and move beyond that.
That's wonderful. I'm really pleased that we can end on an optimistic note. And, it just remains for me to express my sincere gratitude, to the panelists for a very interesting and illuminating discussion. It was really my great honor to have a panel of this caliber. And I just thank you once again for your participation.
Thank you. Bye-bye.
Thank you,
Thank you.
Desmond, for carrying this. And
Thank you. Bye-bye.
Thank you. All the best. All the best.
Thank you.
Thank you. Excellent.